Hey, everybody. Welcome to the morning market briefing. It is Monday, February 14th, Valentine's Day. Hope everybody is doing well. Hope you enjoyed the Super Bowl, the weekend, all that good stuff. Picking up in large part where we left off last week, major headlines on the Russia-Ukraine front. Biden and Putin spoke over the weekend. We have all kinds of people weighing in on what they're expecting. Ben, give us kind of the lay of the land as it stands right now, and if any expectations for you changed in terms of how imminent this may or may not be from a conflict standpoint.
Keeps moving around. In fact, all the notes that I had, and I went through and did a deep dive this morning and tried to get up to speed on all of the machinations that happened over the weekend and what the current state of the art is. And then about 20 minutes after I sent out the notes, apparently President Vladimir Putin is going to be meeting with German Chancellor Olaf Scholz, who's in Kiev today and is going to be traveling to Moscow to meet with Putin in person. And then Lavrov said that he has relayed information to Putin saying that, hey, we don't want anyone in our waters. We don't want anyone in our land. And if they do come into the land, then it could be hostile. But I think what has happened over the weekend is basically this. And that is, it is becoming increasingly clear to me that Vladimir Putin doesn't want a hot war with shooting. I think that what he's trying to do is destabilize the whole situation, make sure that Ukraine doesn't join NATO, and continue to breed uncertainty within Ukraine. So if the Ukrainians are on edge about stuff, and gradually the Russians kind of infiltrate and provide some sort of stability. And I know it's kind of weird saying, hey, the country that's camped out on your border is going to provide some stability, but they're already talking about puppet governments in Ukraine in certain areas. And I think that that's kind of the Russians' MO, is to destabilize, make things very uncertain, and then also come in with the other hand. It's the classic good cop, bad cop scenario. And they're going to come in as the good cop, save the situation, and the Ukrainians will become more favorable to Russia, thereby not joining NATO, and thereby allowing Russia to establish more of a stronghold. So I think that's the ultimate strategy that Putin's playing. And so the more that we ramp up this frenzy, I think the more that it plays into Russian hands. Having said that, it's a bit of a game of cat and mouse, because you don't want to completely roll over in case Russia does decide to open a shooting war. So it's a touchy subject. On Friday, the market sold off significantly because there were concerns of a shooting war that could take place imminently. There was a PBS journalist who came out saying that there's an imminent invasion of Russia and Ukraine. They kept indexing it to sporting events, saying that, and then the administration came out saying that we thought that they would wait until after the Olympics are over to invade. Now it could be before the Olympics. It may even be before the Super Bowl. So it's just kind of this odd information and misinformation that's coming through all sources. And the US government is the most paranoid about imminent Russian invasion. Then you have the UK that says that an invasion could happen, but there's a window of opportunity for de-escalation diplomacy. And then you have Germany and France who are actively negotiating with Putin. And then you have Ukraine on the far side that just says, hey, we don't think anything is happening. So it's a very difficult balancing act. It will pay to be nimble. It'll pay to have some defense stocks, some energy stocks, which we do have. And I think that ultimately the portfolios we're trying to build are built for scenarios like this. And that's not to say the portfolios might not go down in the near term if something were to happen. But it is to say that we don't think there's permanent loss of capital. And that's one of the things that we really try to preserve here.
Yes. Kind of a weird situation. I don't know. It almost seems like the more we talk about this and the longer it goes on, the lower my expectation is for, I guess, severe and meaningful conflict. I don't know if that's a correct assumption to make, but that's kind of where I fall down. I agree. The maybe the weirdest part of the whole thing was how they kept talking about they would wait till the Olympics were over, and then they decided, no, maybe it's going to happen before the Super Bowl. I mean, it's hard to really reconcile, how did Russia's plans change when Odell Beckham Jr. got hurt in the Super Bowl? Like, these things just seem very unrelated, and like the timetable that we are assigning is just something we're making up and going with it. Goldman Sachs, meanwhile, has cut their S&P 500 year-end price target. They lowered it to 4,900 from 5,100. They reiterated their expectations for earnings per share for the S&P in 2022. They raised their target for 2023. So if you expect earnings to be what you thought they were going to be, and you have the market going down, you're obviously looking at compression from a valuation standpoint. Ben, how much of that compression do you think is already, to at least some extent, priced in?
Yeah, I mean, I think they were just kind of responding to the market decline, quite frankly. And it just kind of goes to show how nebulous a lot of these year-end price targets are from the investment banks. And I just wouldn't read too much into it. I mean, they lowered the price target, but they actually raised the actual fundamentals of the economy, basically because the stock market went down. So they're not being entirely consistent, and they just don't want the market to go down and then still be sitting with a 5,100 target on it. So they want to remain relevant on it. And if the market goes up, guess what? They're going to raise that target again. So that's just how it works.
Yeah, heavy on the responsiveness there. We talked about that in a number of different contexts over the last week or so, where people just seem to kind of react, especially in the analyst community, to what's already happened and try to make something that's more forward-looking based on the most recent trend. So that's kind of where we are. On the supply chain side, continuing to see just these weird issues. Hong Kong has a bit of a COVID outbreak. There are over 2,000 cases for the first time. This is certainly threatening the government's COVID zero strategy. Meanwhile, on the bright side, we do have the Ambassador Bridge, which connects the U.S. and Canada, reopened. They had been closed for 5 days due to protests. Canadian police came in yesterday and were arresting protesters. Basically took them the entire day to do that. Then this should provide some relief. We've talked about companies that were affected, especially in the Detroit area. Where do you kind of see this going? I mean, is there going to be more protests, or are we just going to kind of continue to see this play out, or have we moved past it, do you think?
I'm encouraged that the protests are kind of being dealt with at this point in time. The Hong Kong COVID outbreak is something that I'm watching, because the government's COVID zero strategy is certainly means that over 2,000 cases is not zero COVID. And so I think that's something to watch going forward. And we know that time and time again, we've tried to look past this COVID stuff, but as it starts to pop up, especially in these more authoritarian governments, which just shut things down, my concern would be that they shut things down. But having said that, China is very much on the front foot in terms of trying to get economic growth this year, and they don't want to get shut down again. So I would guess that this will be kind of a passing wave in Hong Kong, but it's definitely something to watch. Encouraging that the Canada and the US trade line into Detroit is open. That should be good for the automakers today.
Good deal. Interesting week ahead. We do have some earnings trickling in. We're going to hear from companies like NextPoint, Cincinnati Financial. We'll also be getting a decent amount of economic data, PPI, on Tuesday morning. We'll get a read through on jobless claims Thursday, like we always do, and meetings from the Fed. Tom, I want to throw it to you. What's going on in bond world, rate world? What's catching your eye this week?
The big news is that Bullard, who was the one who sent the market spiraling last week, is currently speaking on CNBC. So hopefully he's not doing anything major, but the early indications, just based on how rates are moving, is that he's saying something relatively dovish, because we're seeing a little bit of strength in bonds today for the first time in a while. And the rate cut probabilities have cooled off significantly over the weekend as well. When we left on Friday, the odds of a double hike, we're basically certain for March, and now we're seeing that move back down. So we were at 1.88 to end the week. We're at 1.67 hikes right now. So it's still looking like we might get a double hike, but it's significantly less so than we did on Friday. It's just, PPI, that number is going to be crucial. If we see another just massive number on inflation, that's going to hurt. The question is, at what point have we oversold on bonds? My feeling is that we're already there, but that doesn't mean that we can't continue to sell off. But hopefully, my hope is that we'll see a little bit of a cooler number, and that'll kind of at least set them to the bottom here on bonds. But it's been a tough start for the year in bond world. But the good news is every time we buy a new bond, you're getting better rates than you did for the last 4 years. So we need more bonds to get called, need more income to hit the account so we can start taking advantage of some of these higher rates.
Good stuff, Ben. As we look at the week ahead, what are you most interested to keep an eye on?
I think the Cisco earnings, the NVIDIA earnings, that'll happen on Wednesday evening. And then you're also looking into Thursday where you get the FOMC minutes. And I think those minutes are going to be very widely watched. I think that a lot has changed since the FOMC meeting. So I think people could read too much into it, but I'm going to be interested in that Cisco and NVIDIA report, see what the state of tech hardware is. And so Thursday is just going to be a big day from all around because we get the reactions to those earnings plus the FOMC minutes. So buckle up. Thursday will be a big one.
All right, we're going to wrap it up there. We'll be a little short today. We'll be in tomorrow morning at 8:30 for the call. Hope you have a great day. Talk to you soon.